Welcome to a brand new episode of Machine Learning Made Simple. Here we unravel the enchantment behind machine learning, demystifying all the technical jargon. I'm your host, Shogato, and I'm here to chat with you about the revolutionary changes unfolding right before our eyes in the tech world. Let's dive in. Welcome to another episode of Machine Learning Made Simple. We have been doing a series on reinforcement learning. This is part 3 of that series in reinforcement learning, or RL for short. We have talked about reinforcement learning in broad strokes, and we talked about Markov decision processes, or MDPs for short. And we have also talked about K-arm bandits, and those seems like a mouthful. Essentially, we did talk about exploration versus exploitation, and when exploration is important and when we should stick with exploitation. And then we talked about greedy algorithms, where we should only stick to exploitation. For example, if we go out to eat and we found out that restaurant that we like, we can keep going to that restaurant. In fact, there are some people who only go to a single restaurant day after day. But now the epsilon greedy algorithms say that our rewards are maximized even better than just doing a straight greedy algorithm of exploiting. If we do find a restaurant we like, we still should go out and explore other restaurants that we might like even better. In fact, they found the ratio is like 10% is found to be the exact percentage which gives them almost the best results for exploration versus exploitation. So if we go out 50 times in a year, maybe 5 out of those 50 times we should explore new restaurants. Like 5 restaurants should be new out of those 50 restaurants. So 45 times we can go to our restaurants, our favorite restaurants, but 5 times we should explore. Now this exploration percentage is much higher for younger people, and people who are getting stuck in our ways, like me, who are getting older. Then we should go out and explore more, and that I keep telling that to myself. And even that goes with career. Like, let's say we are data scientists and we are well versed with tech stack like Python, but we should also upgrade and upskill and look for other technologies. Maybe learn Rust. Rust is closer to Python, but it also is a very versatile and dynamic language which helps build those front ends that we see. In fact, many of those front ends, Google Drive and others, are kind of written in a variation of the Rust programming language. Or if we're front end and we are stuck with a tech stack, Java, JavaScript, then we should explore Scala, which is closer to Python, but mostly along the Java side. They use the Java backend. It mostly Java, but it has the Python syntax, so it will be an easy transition towards Python and data science. So that exploration might pay off in the long run. That's what I am saying. That's what the algorithmic strategies are saying in those epsilon greedy algorithms. So here's how we can apply those algorithms in our real lives. In fact, there is a book called Algorithms, where it tells us how we can use those computer algorithms in real life. And now I'm telling you that you can use these reinforcement learning algorithms in real life. So one example is epsilon greedy algorithms. 10% of the time in anything, explore food, restaurants, career, books. If I read mostly non-fiction, mostly technical books, maybe 5 to 10% of the books I should read which is fiction, or at least biographical or historical. Right now I'm reading a few books which are not just technical books, something that's with civic and society, that expands my knowledge, makes me more well-rounded. So 10% I will explore beyond tech. So that being said, so given those exploration versus exploitation, now always the strategies, we can just explore, but what are the real strategies to explore? Now, if we are going down a road and there are only 3 possibilities, like if we're studying for college and there are really 3 possibilities, we can stay in college, we can stay in college and graduate, or we can stay in college and not graduate, or we can drop out in the first year, or we can just extend it forever and graduate in 10 years or whatever. There are few possibilities and there are not few choices. We have to choose one of them. So that's a very deterministic approach, and we know the environment very well. But then there are scenarios where the strategies are almost infinite. Let's think about financial markets where there are infinite strategies. Some strategies work, some strategies don't work all the time. Okay, the bull markets, there are momentum strategies which work in bull markets, and bear markets. Option writing might work in the bear market. The famous example is the long-term capital management, and those brilliant scientists, they thought they can really game the system. They have an exact theoretical model where they did pair trading with very high Sharpe ratio. Essentially, it means that they have like zero upside or downside. They essentially arbitrage the whole market. And since the profit margin is so low, they got like 0.01% profit or anything, but it was almost risk free because it was pairs trading. By pairs trading means like we pair two stocks in tandem. Let's say, for example, Apple and some other stock which trades in unison, or a better example would be Ford and GM. Let's say GM goes up, Ford will go up with GM because they are highly correlated auto industry. So what we can do in pairs trading, we can go long GM and we can go short Ford, which means average they should cancel out, and technically, theoretically, you should not make any profit, but because of the market disturbances, because the inefficiencies in the market, if there is some shock to GM, it will take some time to propagate to Ford. So the GM stock might suddenly go up based on good news, but Ford stock might lag behind. So we'll then, because we're long on GM, we'll make some profit there. And we're short on Ford, so we don't lose money there. But when it reverses and now Ford is going up, then our stock will balance each other out and we make money both ends. But since this has a very thin margin, it needs to be leveraged up like 10, 20, 100 times. And that's what long-term capital management did. Little did they realize that market condition is sometimes can be very brutal, and as Maynard Keynes said, that the market can remain irrational longer than you can stay liquid. So long-term capital management, they maintain for a long time, and maybe even still they maintain that they could have survived the whole thing if there was more influx of cash and the market would have corrected itself. And the market did correct itself, but by the time the market corrected itself, there were billions of dollars in debt, and they pretty much took down the entire market by itself. The regulatory committees had to come down and bail them out. So the point is that the market conditions do not always are conducive to a particular strategy. So that's where the reinforcement learning comes in. That's where the Monte Carlo methods come in. They are so attuned to the market. They are continuously learning, and then they immediately realize that, okay, theoretically this shouldn't happen, but this is happening. Like during the early 2000s, that's what happened. The Russian ruble went down drastically. It lost value completely. And if you're having a pair strategy, then you are probably in whole on one side, and whether short or long on the other side is holding and one side just completely fell away. So it's like floor falling off, and there is no way to recover from that pairs trading strategy. But the Monte Carlo methods will recognize that the market microstructure or macro structure has changed and adjust dynamically. Right? And now you might notice that I have three segments. One is Monte Carlo methods, which changes according to the environment and learns from the environment. And there is also dynamic programming. So dynamic programming should not be confused with dynamic pricing. Dynamic programming is a much better method, but it also assumes a complete knowledge of the environment. So now, for example, if I say that, okay, I'm going to be a dentist. Right? Now, is that a well-defined problem? Yes, it is a very well-defined problem. All the books are available. Every tool that I need is available, and everything that I need to do to become a dentist, including the final exam and all the exams that need to be passed in order to become qualified to become a dentist, all that information is out there. Now, given that environment, that's a completely solved environment, completely known environment, I would still need some kind of a strategy. Right? It's like saying that, okay, I want to get a degree in physics or mathematics. there are thousands and thousands of universities, right? It's a solved problem. It's a known environment. But why do still people rack their brains in order to figure out the best way, the best schools to get into? That's where the dynamic programming comes in, because even though the environment is fully known, there are multiple strategies, and there are some strategies which lead to poor results and some strategies which lead to much better results. So, for example, a better strategy of becoming a academic in physics or a physicist would be to get a very high GRE score and get into Princeton, publish a very good paper, and work with maybe a Nobel laureate, and go to a postdoc at IIS or somewhere else, and then the academic path would be set. That would be the best strategy. Now, there are other strategies as well. We can go to Brown and keep it simple. Then we can graduate and go to data science. We'll probably not graduate into becoming a physics professor, but it's also a strategy. So this is a known environment of studying and getting a degree in physics, but there are different strategies. Which strategy is the most optimal, which one is the best, depends on what kind of reward we are seeking at the end. And that is where the dynamic programming comes in. In a known environment, what is the best strategy given a very specific goal? Because different goals have different optimal strategies. And people and mathematicians, computer scientists have pretty much optimized and made it theoretical. We'll not go into theory too much, but we might, if you are looking at the video segment of this podcast, you might encounter a few questions. I'm not going to explain the equations, but it will just probably flash along with the slides as I'm talking about. So now let's talk about the different segments. So first we'll start with the Monte Carlo methods, where the environment is unknown and we're trying to find the best strategy given a very specific outcome. Okay, so let's say a Monte Carlo method would be maximizing our profit by dynamically adjusting price on our website. So let's say we are selling coffee beans, or we're just selling all kinds of coffee online, and the demand is fluctuating, and are we going to adjust the price or keep the price fixed? We realize if we add a few cents here and there, we can maximize our profit based on the demand. Now that environment is completely not deterministic. It's completely unknown because the demand fluctuates and it cannot be forecasted, and that's where Monte Carlo comes in. In the unknown environment, it can simulate and dynamically change the prices with dynamic pricing. Now there's another method what we can do in Monte Carlo, and another use case. Another use case would be if we have a robo vacuum which is learning to clean our house. The robo vacuum usually starts from its home base, but sometimes it doesn't start from its home base. So when it starts from its home base and maps the environment, it is essentially performing some kind of a reinforcement learning and doing Monte Carlo, some form of Monte Carlo, not exactly Monte Carlo, but it doesn't always start from its home base. Sometimes it starts from somewhere else. We might put it somewhere else. So it needs to learn to start from an arbitrary position. So there is also a method in Monte Carlo where we start with an exploring start, which means we start from random location and then figure out how to learn from that environment, changing environment. But when the environment is completely known, like we talked about in the dentist example, then we can use dynamic programming and find the best and optimal strategy given our goal, because some people's goals are different given the same environment. So two different people both want to get a degree in physics. One want to be a physics professor and one want to be a data scientist and just want to have a degree in physics so that they can brag about it to friends. They have different reward functions, different goals, so their strategies would be different. The person who wants to be a physics professor probably will go for Princeton, and person who is trying to be a data scientist, they don't need to go that route. It's just too expensive, time consuming to go that route. They will just get a bachelor's degree from Brown University and go the data science route, but they can still have the bragging rights that they have studied physics. So let's start with the Monte Carlo methods, the plain vanilla Monte Carlo methods. So whether you're trying to set prices, dynamic prices, optimize your marketing strategies, or just manage inventories, these are the different methods that we can use to make smarter, data-driven decisions. So what are these Monte Carlo methods? The Monte Carlo methods are all about learning from experience by simulating different outcomes and seeing which ones are working the best. And here's the caveat about it. We don't know anything about the environment. The environment is completely unknown. We are just learning by exploring. Okay, so imagine mapping out the environment, scanning the environment using a 3D scanner in the dark, like the deep sea missions where they scan the ocean, bottom of the ocean using the 3D scanners where they don't nothing. It's completely dark and they're scanning it for the first time. So imagine trying to make a decision when you don't have all the information, right? You could guess, you could rely on intuition, or you could just do something in a systematic fashion. You could run a series of experiment or simulations and then use those simulations to guide our decision makings, right? So for example, let's say we want to predict the consumer demand for our new product, but we don't know exactly how many units we're going to sell in the first month. What we can do is run a different bunch of different simulations, each with different set of assumptions, like one where the demand is high, one where demand is low, and where demand is somewhere in between. Each of these simulations will kind of give different outcomes, and by running enough of them, thousands and thousands of them, we might get a sense of the range of possibilities. Another example would be planning a marketing campaign where we don't know how the customers will react to the ad, but we can do a Monte Carlo simulation to mimic the customer behavior. Maybe one simulation will assume that the customers are price sensitive, another simulation will assume that they're more focused on quality, and then run the simulations and see which scenarios plays out and which one works. We need a little bit of input on this, like our past input or the demographics we're targeting. And if we have a stratified sampling of the demographics, their income level, and then that kind of input, income level and everything will help with this simulation, right? So if we are having a very niche product, then the customers might be less price sensitive. And let's say we are only selling a very specific fish net, which only specific fishermen can use for commercial fishing, then most people will be indifferent to that. But that specific segment of fishermen who do need that fishing net will not be price sensitive at all. In fact, they will be more sensitive towards quality. We know that from knowledge overview, but that's a very broad strokes example. But you might want to make it more concrete by gathering the data about those commercial fishing lines which have made purchases like that fishing net in the past. Or if we have a more generic product where we are selling, let's say, a pencil, a 2B HB pencil, then it will be completely elastic and people would be more price sensitive to this product. In fact, microeconomic principles kind of pretty much guide all these. So these are very simple examples. We don't need to run Monte Carlo for these examples because they're so simplistic. But if our product is more novel, let's say we are selling an ice cream lollipop, which is essentially a lollipop, but it's like an ice cream on top, ice cream on a stick, then this is a novel product. Now I'm guessing this product would be for price sensitive buyers, because who wants to pay $50 for that kind of ice cream? But if it turns out that it's a high quality product which celebrities are enjoying, like those famous smoothies that certain celebrities are endorsing, then your demographics will shift. Then you will know, okay, my customers are not price sensitive, they're quality sensitive. Then you have to use higher end ingredients to make that product, that ice cream lollipop, as an example. But we don't know unless we actually run those Monte Carlo simulations. You have to hire a data scientist, let them gather all the data about the demographics, about the product, and see and test out, simulate in each market scenarios, in each demographics, see which demographics will respond the most given those ingredients. Let's say we have a certain pricing system with let's say high-end demographics will prefer certain ingredients, let's say matcha and all those sugar-free high quality monk fruit sweetener and all those high quality ingredients which are very costly, and then we're going to price it higher, and we can run the simulations and see what price will allow us to make a profit and also generate sufficient demand given that tiny slice of demographics that this product will appeal to. Or we can totally change the model and run a different simulation where we have a smaller, cheaper product with cheaper ingredient like high fructose corn syrup and other cheaper ingredient, and then give it to a more general population who will want to not spend too much on this. Then we have to bring down the cost, and then we see where we are going to set the cost. And both of these scenarios will have their own pricing model, and all these pricing models will be based on those Monte Carlo simulation. So that's an example. That is a concrete example. So now let's look at a few more concrete examples of this pricing strategy. Let's say we are doing this, we're running a cafe. One approach to running this cafe is to do a dynamic pricing. We could start pricing our coffee that we are selling in our cafe at a set price, and we can keep that, but the demand will fluctuate and so will our profit. Or we can dynamically set the price. This is a very simplistic example. Most cafe shops can do that. Starbucks, the coffee chains can do that, but most mom and pop coffee shops cannot do that because this is an expensive way to. Dynamic pricing is kind of an expensive strategy. It requires data scientists to run the simulations. But let's go along with it, and let's say we are running a coffee. Let's say I'm a techie who wants to quit our job and start a coffee shop. Then this is how we will approach this. We will sell, let's say, 80 cups at some price and make some profit, and the next week we want to raise the price slightly, maybe $3.10, and then the demand drops and we sell less coffee, but we make a little bit more money in terms of profit. And maybe next week we drop the price a little bit and see what happens. The demand will go up, and we can figure out, right? So this is how the discounting works in certain shops where they offer sales and see what the increase in demand is, right? So sometimes you hear all the sales going on in certain shops. They are testing out those pricing strategies. So let's say Macy's gives you 10% discount, or Bed Bath & Beyond gives you 20% discount on their products. They see the surge in the demand, and from that their reinforcement learning strategy can gauge, okay, so after giving 20% discount, there was a 30% increase in demand on consumer goods, which cost between $10 to $20. But there was not appreciable increase in anything above, which cost anything above $50. But when they increased the discount to over 30%, then there was a high surge increase in demand of, let's say, 20 to 30% of any product which is above $50, which means that customer segment who shops anything below $50 is responding to a 20% discount, and that customer segment which shops anything above $50, which means the high-end customers, are responding to a higher discount because they have more to gain and their time is more valuable. So they're not going to go to the shop for a tiny discount, 10 to 20% discount. They're not going to bother getting into their car and driving all the way to Bed Bath & Beyond to avail of the discount because it's not much. They're going to save $10. They don't care. But if they're saving $20, yes, maybe they want to get into the car. So that's why certain discounts, certain price points affect certain demographics, and demands are fluctuating. So it's almost impossible to model this using analytical methods, and definitely I won't even try to do it by hand. And that's where these Monte Carlo methods come in. This dynamic pricing based on these pricing strategies come in, and this can get pretty technical, so we don't want to get into that. So let's look at a few more examples where we can use those dynamic pricing. One of them is using dynamic pricing on e-commerce websites. In fact, Amazon does it all the time. In fact, I see on my own computer that the price changes. So let's say I'm logged into my account, and let's say looking at some prices like printed handkerchief. There will be some price on my account because I have purchased these, let's say, before. So I'll see, let's say, $10 a piece. But when I go to the private window, the price might go up to $12. Why would the base price be $12 and I'm seeing $10 in my account? Because it's incentivizing me to buy that, because it knows at $10 a piece, I might buy the handkerchief, right? It is incentivizing me, knowing my past buying experience history. It is pushing the reinforcement learning, is dynamically pricing it so that it encourages me to buy it. Okay, it knows at $10 I'm going to buy it. If it becomes $12, guess what? I'm not buying it. In fact, I will not buy it. If it drops to $8, definitely I'm buying it. The dynamic pricing in these e-commerce websites are nothing new. They have been around for a while now, since the websites existed, but they were more rule-based before. But now they are becoming more attuned to consumer behavior. Usually they used to be demand driven. So if the demand goes up, the price goes up. In fact, some of those old algorithms were implemented in Ticketmaster, and once the Ticketmaster prices went up substantially during high demands or for a specific concert. Similarly, there was Uber got into hot water because their algorithms were not upgraded. And there was a certain shock during a flooding. There was so much demand for Ubers that the prices went up 10 times. And there was widespread criticism for Uber for price gouging. But those prices were dynamically set, and they were not really monitored by human beings. And I'm guessing whoever programmed that didn't set an upper limit. They always should set an upper limit of the pricing. But due to the surge pricing, because the increased demand after the natural disaster, there was such a high demand that prices for Ubers and Lyft went up 10, 20 times. And people were really angry about that. And there were multiple reports about that. Uber later apologized publicly, Uber or Lyft, I forgot which one of them apologized publicly for their surge pricing and price gouging, and they said that it's the algorithm who did it, and they were not really monitoring it actively in a manual way. But after that, I think they put an upper limit on the surge pricing, but they should have done it from the very beginning. It's kind of obvious thing to do. I'm guessing the programmers were not very careful, or maybe it was a business decision not to provide an upper limit to the surge pricing. So there are issues that we need to be aware of when we use reinforcement learning in Monte Carlo for dynamic pricing. And now when we talk about Amazon, that dynamic pricing used to take into account demand, and the demand surges. Now they're also taking into account the customer behavior, or customer purchasing behavior, purchasing history, the times the customers didn't purchase and they waited for the discount. All of that is taken into account. They know that when we put something in our cart and wait for the price to drop, in fact, Amazon can actively monitor things that are in our cart, and they give us incentives like drop the price just to make us buy. And in fact, I know some people who just add things to their cart and wait for the Amazon algorithm to trigger and give them the discount, 5 or 10% discount that they have been waiting for. In fact, the algorithms might do that. Sometimes you will get a good discount if you just add stuff to your Amazon cart and just wait it out. If you're willing to wait 1 or 2 months, you're definitely going to get the discount, whether by fluke, by accident, or because the algorithm has decided, okay, we can dynamically price this lower. The inventory is really getting high. We're going to price this lower. So the Amazon algorithm, I'm guessing, not only takes into account demand, it also takes into account consumer behavior, pricing structure, and also inventory buildup. If there's too much inventory buildup, they'll definitely try to offload some by giving discounts. And if it notices some people have that in those products in their carts, their Amazon is definitely going to give out discounts to get rid of their stale inventory. In fact, that's a good strategy. In fact, you should implement that. So we talked about the dynamic pricing in e-commerce websites, and we also talked about the cafe pricing strategy. And the main place where the Monte Carlo methods are really used are the insurance markets. Okay, so it's a big place to apply Monte Carlo methods because it's kind of deterministic in certain sense, because we have well-defined statistics of mortality rates of each activity. In fact, the insurance companies have databases of what activities have what mortality rates. Even I saw a book there, what is the mortality rate of trying to ride an eagle. It's a funny book, but it gets the point across. There are statistics for each activity: bungee jumping, tandem skydiving, motorbike racing, cross country skiing, all of these have an associated mortality rate, and depending on your activity level, and these insurance companies have a good handle on what kind of activities we indulge in, they can assess what is the mortality risk of each individual, and then they can decide what should be the insurance premium. Usually the insurance premium is at least 10 times their actual cost. So the other place that the Monte Carlo simulation really shines is the stock portfolio optimization. In fact, anything with stocks, if you are into exotic options, if you know about in and out options which don't have a theoretical solutions, in fact even regular options don't have theoretical solutions, people like to use Black-Scholes options, and they are notoriously bad because there's so many assumptions that goes into the Black-Scholes equation. I mean, we have to plug in the volatility. I mean, who knows the volatility? In fact, the stock market uses the Black-Scholes in the reverse manner to actually calculate the volatility of the market. I mean, Black-Scholes really cannot predict the stock option prices, even though it's used in theoretical models and those diagrams that you see on those websites. What works? What works is Monte Carlo methods. When we use reinforcement learning, when you use Monte Carlo methods, we can go through all possible values that the stock price can take, and we know the historical volatility, we know the recent shocks, we know the interest rates. We can actually simulate by a diffusion model how the stock will behave. In fact, I have run the simulations and it gives surprisingly good results of most of the options. You can do any options, but it's especially useful for options which don't have a theoretical results, like in and out options and other exotic options. In fact, it's very useful for American options. American options can be redeemed at any time, which makes them highly complex. So Monte Carlo methods really help there. So now let's talk about why Monte Carlo. Now, Monte Carlo is really helpful when we have a very uncertain environment, right? When we have a very uncertain environment, Monte Carlo is the way to go. In many business situations, we don't have a clear, detailed model of our market or the customer behavior. Instead, what we have is a lot of unknowns. And this is where these Monte Carlo methods shine. They allow us to work with that uncertainty by running repeated simulation to explore those different outcomes. Let's take another practical example. Let's say we are managing an advertising budget, and we don't know exactly how many leads we will generate from each campaign, nor do we know that what is the exact cost would be per lead, right? And now what we can do is simulate different scenarios. We can model what happens if your cost per lead is higher than expected, and what happens if your campaign performs better than expected. So, and we can simulate these various possibilities, and we can get a better sense of how we can allocate our budget across those different channels, right? It's not just about finding those average outcome. This Monte Carlo would help us understand the full range of possibilities. What is the worst case scenario? What is the best case scenario? And how likely are those extreme outcomes? And that's important. Knowing the extreme outcome is very important, especially if you're running a stock trading strategy, because that can pretty much ruin a portfolio. Okay, so this way we're not just planning for the most likely outcome, we are preparing for everything that could happen. Those fat tail, in fact, the fat tails are the ones that ruins portfolios. So from best all the way to the worst, right? We get ready for everything. That's where people can just forget Monte Carlo and just take the average. But guess what? The average is average. If we just do the average, we get average result. We need to be prepared for the worst outcome. We need to be prepared for the best outcome, right? It's a comprehensive way of handling risk. Okay. So it also helps the business become more agile. In an uncertain market, the conditions can change quickly, and then we don't know what to do, like what happened to long-term capital management. Then if we have a tool like Monte Carlo, then we can simulate different futures. And that's an invaluable tool. Let's imagine we can test different strategies, whether the product launches, pricing changes, marketing tactics, and see how they play out in future, even before we actually commit to any one of those strategies. And that's exactly what the Monte Carlo is offering. It's like running thousands of what-if scenarios and learning from each one of them without having to risk the actual resources. I mean, this is a brilliant idea. Now you might say that, okay, so, but what about just doing some other method? Why do Monte Carlo? Why not use a theoretical model? The reason is that we don't need all the data up front. So the rigid decision-making models that are in existence, they're more rule-based. They need a lot of data. You give me data for demand, then we can forecast what strategies are going to perform better based on that data set that we have. Give me the customer behavior data. Give me pricing behavior data. Give me all those data, demographic data. Then those rule-based algorithms can give a prediction. Monte Carlo doesn't care about all that. Even we have very finite amount of data, it can still it can work very well with this partial information. So even when we don't have perfect data, we can still make informed decision by running those simulations and learning as we go. See you next week. Thanks for listening. That's a wrap for today's episode of Machine Learning Made Simple. If you have questions or want to explore AI topics further, please don't hesitate to leave a comment. Until next time, keep exploring and enjoy your AI adventure.